And thank you for joining us for our semi-annual market outlook. I'm Betsy Pierson, Chief Investment Officer at Midland Wealth Management. And joining me today is LaPorta and Dan Zeigler, who are both portfolio managers in our group. Before we get started, let's have a couple housekeeping items. First of all, everyone on the call is on mute. And if you have any questions, please enter it in the chat box and we will answer the questions at the end of the presentation. This presentation is being recorded and will be available on our website by Thursday morning. So let's get started. 2021 was certainly a great year in the equity market. U.S. equities were up over 26%, while international developed was up almost 13%, and emerging markets were flat, along with bonds being negative. While investment grade bonds were negative this year, over the last 10 years, they have actually provided fairly good returns, on average about 4% annually since 2012. High yield has been the best performing, but they're more equity-like, and that would explain that, as equities have had a much greater return. Equities have also had a great return over the last 10 years. U.S. equities have returned over 16% annually, and international markets are up over 8% annually, while developed emerging markets are up over 6%. It certainly has been a great time to be an investor. As we ended 2021, COVID continued to be in the forefront, with spikes in the number of confirmed cases. The Omicron variant, being very contagious, led to an ice pick spike in late December and early January, as they call it, an ice pick spike, which was very similar to what happened in UK and South Africa. In both those instances, the number of new cases fell pretty dramatically after it hit its peak. While it is still spreading across the United States, some areas have seen daily cases plummet from the highs. And one positive to this, all of this in general, is that the number of fatalities per 100 cases, as seen in this inserted chart, has dropped dramatically from back in the beginning. And back in May of 2020, it was close to 6.5 people dying per 100 confirmed cases, and now we're under 1 and closer to 0. This has been made great strides since the vaccine and new medical technologies to help treat the virus. Despite the recent run-up in cases, the economic recovery continued into 2021. This chart shows the high frequency data, which is similar to hotel occupancy, seated diners, and travelers, which are things that were very negatively impacted by the shutdown in 2020. It shows a year-over-year growth, and then as of March 15th, 2021, the year-over-2-year growth. And as you can see, they all have increased pretty dramatically and almost back to pre-COVID levels. We have seen a little downtrend here as the Omicron variant has caused spikes in the virus, but we do believe that that will get back on track and we'll be back to close to pre-pandemic levels at all those on the growth rate standpoint. Employment is also back to pre-COVID levels. If you look back at December of 2021, which is our most recent employment number, unemployment was at 3.9%. And the peak it hit was back in April 2020 at 14.7. But if you see, it's very close to where it was back in March of 2020. We've seen a nice return. In addition, wage growth has grown up to 5.8% this last year. While it seems extremely high, we were on a trend for wage growth pre-COVID since the bottom back here in 2013. You can see the increases that we've had. And while it's higher than it was in March of 2020, we definitely were on an upward trend anyways. Finally, overall economic growth in the United States is moving back to the trend growth rate. The trend growth rate is 2% on this chart. You can see back in the financial crisis, we got a little ahead of schedule and then went into a fairly deep recession in the great financial crisis and moved back closer to the trend line pre-COVID. Saw the recession of 2020 when we had the shutdown, but we are almost back to that growth line. We're going to have a growth rate probably over 5% for the annualized for the fourth quarter, and year over year should be somewhere between 5 and 5.5%. So in general, economic growth in the United States is back to the growth rate. We've experienced a good recovery, and that's a good way to end the year. So what should we expect heading into 2022? Chris, we have seen a strong bounce back from the recession in 2020. Can you continue Can we continue to grow, and at what level of growth should we expect?
Thanks, Betsy, and good afternoon, everyone. I think that question is going to start with the consumer, and looking at where we are as a consumer, we're in a really strong position heading into 2022, and this has been taking place for some time. The consumer balance sheet, the assets versus liabilities, is really, really strong. Consumers have a high savings rate, increased net worth, and really low debt compared to their household income. We're still seeing some pent-up demand for travel, hospitality, leisure activities, and even some reversion to the norm that we saw pre-pandemic. Consumers are expected to spend more heading into 2022 and 2023, and they've been saving to do so. On the other hand, since the global financial crisis, consumers have been saving more and shying away from debt. But we could see that flip-flop as we see higher interest rates and inflation continue to pick up. While there are some signs that the situation might go towards taking on some more debt, it's probably a little bit too early to make that decision, and what the consumer decides to do to spend their money, whether they take on increasing revolving debt or they start spending some of their savings. We'll probably see how that plays out over the next several months. Another interesting chart, and something that we've seen a little bit of a phenomenon go on towards the middle to end of 2021 and continuing into 2022, is what's been deemed the Great Resignation. A record number of Americans quit their jobs this past year, almost 4.4 million alone in September. That's roughly 3% of the American workforce leaving their jobs in a single month. And that doesn't necessarily indicate that they're quitting and not going back to work. Some of it is some retirees. Some of it is people quitting and not necessarily looking for work immediately. And some of it is people quitting and looking for new opportunities, higher paying jobs, new growth opportunities, being patient with their decision making. So we've seen a lot of workers quit over the last year. Counterintuitively, quitting is not necessarily a bad thing when it comes to jobs in the workforce. This tends to be a good sign for the economy. People tend not to quit during economic times of distress. They're going to quit in times where they feel confident in the economy, they feel confident with where they're at. And as we looked at the chart before, the average person, the consumer, has done a great job of keeping debt low, saving money, and giving themselves a chance to find new opportunities out there in the workforce. On the flip side of that, this is a little bit tougher time for businesses. Businesses are looking to fill open positions. We've had a labor shortage over the past year, and those have been in a lot of industries where we have lower wages or higher contact with people. Specifically retail, hospitality, those type of industries, even in the medical industry. There is some questions as to how this plays out for the businesses, but overall this is a good sign for the economy and the American workforce in the long term. So from a GDP standpoint, what should we expect going into 2022 and 2023? Well, we're expecting that a pretty positive GDP growth rate from 2021, as Betsy mentioned, around 5%. And assuming that inflation and economic growth track with the forecast that we're seeing put out there, we're hoping that the central banks won't take too drastic a measure to dampen that growth further beyond 2022 and 2023. The Federal Reserve has already started tapering its asset purchases. That's expected to be done by March. And the expectation for the Fed is to raise interest rates through 2022 to kind of bring us closer to historical norms going into 2022 and 2023. Some positives, that are going to help drive the growth. Obviously, the labor markets, but two, we're seeing a big increase in capital expenditures. Businesses are making investments into their companies, and hopefully, that's going to be put more towards, technological advancements, productivity that could, essentially help boost what the company is making, allow them to grow at a rate, and the factors that kind of really drive what we're seeing, what we're expecting from GDP growth are, the consumer and then businesses putting money back into their operation to continue to grow further and hopefully offset some of the inflationary pressures we're seeing. And with that said, having strong GDP growth, again, we're projecting 5% going into 2021 and maybe a little bit tapering off past that. Again, these are all forecasts, but you can see what's really driving, the projected growth for 2022 and what we're hoping for to see the numbers for 2021, where the employment rate, labor productivity, a lot to do with the labor markets, and obviously strong GDP growth will continue to be a boon for labor markets. The number of unemployed people actively seeking employment is at a record low relative to the number of job openings. The number of people quitting their jobs, seeking out higher paying jobs remains at a record high, as we mentioned. Strong demand for labor is likely to lower the unemployment rate to around 3 to 3.5% by the end of 2022. And that's going to continue to generate strong growth in employee compensation. Hopefully, that strong growth in employee compensation, that wage inflation that Betsy was alluding to, could help offset some of the inflation that we're seeing in goods and services, and hopefully protects the household, the consumer, from having to dive into their savings or putting too much on revolving debt to afford the increase in goods and services. So, we're hoping that wage inflation is going to help offset some of that inflation that we're seeing in the products and services that we use every day. Some potential headwinds that we're seeing, and this is an interesting chart, that potentially we're seeing as consumer headwinds that could potentially slow down growth beyond this year and into 2023 and 2024. But one of those being just if you look at this chart, this is a comparison of what percentage of the household income is going towards housing. So, for example, if you make $100,000, the historical average has been around 5, that your house is going to be around $500,000. So this ratio kind of shows home price to your median income, so what the family's making or what you're making relative to your house. And you can see that we're at historical highs, and if you look at where we were at in 2007, 2006, 2007, we were at that 7 to 1 number, being the house is 7 times greater than your median income. Which means that people are spending more on their housing, but a lot of that could be driven simply by interest rates. Interest rates being lower, being a little bit cheaper to borrow money, people thinking they can afford a little bit more. But that kind of ties into what we're looking at from a purchasing power standpoint with higher inflation. As rates start to go up, as inflation increases, are people still going to have the resources? Are they still going to have what they need to pay for these houses in the long term? And so something that we're watching closely to make sure that where we see the savings rate going, where we see those consumer balance sheets going, we want to make sure those debt levels stay low, and that people aren't spending too much of their savings or putting too much on credit again.
Thanks, Chris. Also, then, we haven't seen inflation above trend for so long. What happened in 2021, and will it subside over the next 12 to 18 months?
Yeah, so I think I think the most popular word for 2021 was transitory, right? That inflation was transitory, meaning um, you know this is a short-lived phenomenon. It's not going to be sticky. And I think the Fed and specifically Chairman Powell has kind of come back to realize that it's a little bit more persistent than they were expecting, obviously. And um, you can see that a majority of the inflation um, has come from kind of goods and services that have been impacted by supply chain issues, and then also energy, which we're seeing a little bit of unrest in the Middle East again, causing some fluctuating volatility in energy prices. And I'm sure most everyone has kind of seen the pain over the last couple of months as they've gotten their gas bills at home, um, or just paying for gas in general, driving back and forth from the office. So we've seen a lot of the inflation come from those sectors in the market. If the consumer price index, the CPI, um, year over year is at 7%. And that's just an average of all these goods and services that we see. And you can see that the highest have been mostly vehicles, energy, and then you've seen it at the grocery store too, through meats and fish and eggs and those products. Um, CPI hasn't been this high since 1982. Um, and at 7%, not only is it competing with historical gains in the bond market, but also in the stock market as well. 7% is something that we have to pay attention to. The Fed foresees hiking short-term rates 3 times in 2022, and the federal funds target rate is currently at 0.25%, and the 30-year average is at 2.52%. So you can see we're well under historical norms as it relates to the short-term rate. The threat for inflation is that it continues moving forward at elevated levels, and forcing the Fed to act a little more drastically with respect to monetary policy. This chart shows what we think will help inflation subside over the long term, and this is just forecasting throughout the end of 2022. But a lot of what's contributing to inflation right now has been a result of supply chain issues that we expect to see through the middle of 2022. Semiconductor shortages are negatively impacting a wide variety of industries, as you can see here: cars, video, audio, entertainment equipment, sports, recreational vehicles, a lot, housing appliances, a lot of what's being impacted by supply chain issues. Even though we've seen some level of relief from late 2021 with the container ships, in the ports of LA and Long Beach, there's still issues there. There's still long delays, and these supply chain issues are continuing to contribute to higher inflation. So we're hoping that as the supply chain issues work themselves out, we'll see some relief from inflation. These industries driving inflation. And to kind of put this in perspective too, 7% is a big number, but if you go back and look since 2001, inflation has been under trend for the most part. We're kind of trending from 01 to 07, 08. Then we had a lot of monetary policy that subsided, pushed down rates, pushed down inflation. And we're finally starting to kind of creep back up to trend levels of inflation. Now obviously we have to do that. We're doing that with a little bit higher inflation rate, right, than the historical averages. But to get us back to trend, that's where we're at. So we're still over the long period operating below trend. Obviously, we feel like that's going to the change throughout the year, but we're still on trend for the last 20 years from an inflation standpoint. Some interesting charts that I just wanted to kind of point out to put in perspective what inflation has, the impact that it has on what we call real returns. So real interest is calculated. The real interest rate is calculated based on the difference between the nominal interest rate, so what you're seeing on paper, and then the inflation rate. So this chart kind of shows the impact, the red line being inflation, the black line being the nominal interest rate, and the blue line being the real return, the real interest rate on that. And this is representing a 1-year Treasury bond. So for example, that we have a negative real interest rate as a result of inflation. So this just kind of shows the impact that that inflation has on the real return. And as I mentioned, that 7% number kind of in a normal stock market return environment has an impact on that as well. So what leads to inflation, and we talked about some labor shortages. We talked about supply chain issues. I think one of the big drivers to inflation, not the only driver, but one of the big drivers is money supply. And we've had several years essentially since the Great Recession where we've had relatively loose monetary policy, and we've pumped a lot of money back into the economy. And so what we're looking at here is what we call M2, and M2 is the money supply. And it's simply a measure of the amount of currency in circulation right now. And historically, M2 money supply has grown with the economy. And recently, it's crossed kind of that 10% threshold that we see, the growth rate of 10% or more. In 01, we had the dot-com bubble. 2008 to 2009, we had the Great Recession, and then more recently, we've had the COVID pandemic. So, those are periods where we had expansionary monetary policy, and including large-scale asset purchases and pumping a lot of money in the economy. But money supply alone doesn't necessarily lead to inflation. As we pointed out earlier, we've had a lot of money put into the economy. But we've also had a lot of savings as well, not only from consumers but from businesses as well. And so what the chart we're looking at here is the velocity of money, and that's the rate that money is exchanging hands in the economy. High money velocity is usually associated with a healthy, expanding economy, and low money velocity is usually associated with recessions or contractions. And we know that we had the recession in 2020. But we've had declining money velocity essentially since the 2007-2008 period, where we've seen the consumer, we've seen the business reevaluate their spending habits. And this is kind of contradicting to what you would expect to see in an true inflationary environment. You would expect to see the velocity of money exchanging hands a little bit more frequently than what we're seeing today. Not to say that can't increase over time, depending on which direction inflation goes. But when you have this low of money velocity, you're typically looking at a deflationary period, and that's essentially what we're coming off of over the last 12 years. In this chart you can see that this was an interesting chart, and I just wanted to use this quickly to point out that. You can see the different deflationary and inflationary periods that we've had, and this is highlighted by the shifts in the S&P 500 and commodity market, which is represented by the producer price index. And when we have outperformance in the stock market, it's typically a deflationary period. When we have outperformance in the commodity markets, it's typically an inflationary period. And you can see since this chart is a little long, right? It goes back to 1887 and even before that. But you can see that we've had significant outperformance in the stock market over the commodity market. But you can see the periods in which we've had inflationary timeframes. We have had a downtrend in the stock market. We've had outperformance with commodities, and typically, stocks perform better in late recessions or early expansions, while commodities typically outperform in late expansions or early recessions. This is just one example of how we see where we potentially are at in the cycle, what we can potentially expect, in the future. It doesn't mean it's going to be a long period of time. These shifts between inflationary and deflationary periods on average are 18 years. But I don't, it's the picture is the deflationary period tends to last a lot longer than inflationary periods.
So, Chris, there's been a lot of talk about the Federal Reserve and what actions they'll be taking in 2022. What do you think the Fed will make? How do you think the Fed will make its moves, and what will happen to interest rates?
Yeah, it's a good question, Betsy. And this is just one of many charts that we've seen with regards to trying to project what the FOMC, what the Fed is going to do over the course of 2022 and into 2023. And I think it's good to just reiterate we're still well below historical norms when looking at short-term interest rates, when looking at inflation. So getting back to kind of what we think the Fed's going to do and what the expectation is we're expecting the first rate hike in March. Whether that's going to be 25 basis points or 50 basis points is up for debate, I think. We're also expecting rate hikes in June and December of probably 25 basis points, and starting to get the short-term rate back up to historical norms. I think I mentioned that historically it's at 2.52%, and we're obviously well below that still. But the reality is that we've had really expansionary monetary policy, and the Fed has being forced more or less to tighten up their monetary policy, and we have fairly dovish Fed chairs and Fed policymakers, and they're turning a little hawkish, and I think that's something we need to take seriously, and expect these rate hikes to happen and to continue through 2022. And as I mentioned, we're expecting the expectation is 25 basis points, but I think the market feels, and we can feel the volatility over the last few days, that the Fed is behind the 8 ball here with their rate hike, and Wall Street is they're expecting 100% chance of a 50 basis point hike in March. So that has yet to be seen, and we'll see what they say tomorrow at the FOMC meeting, and what their decision is going to be on how to move forward. And this is an indicator of kind of where we're at. I think when we look at how the Fed is tightening and what happens to the yield curve when that typically happens. So yield curve is starting to flatten, and that's expected as we're in a tightening policy and the 2 years creeping a little higher. Typically you'll see the yield curve slope upwards as investors expect more compensation for taking on the risk of a longer term bond. But from time to time the yield curve could flatten or even invert. Obviously an inverted yield curve isn't a good sign for the economy in the near term, but we're not quite there yet. We're just starting to flatten a little bit. So some reasons why that yield curve might be flattening. Obviously we begun buying back. The Fed began tapering and buying back bonds. We're starting to worry a little bit about inflation, and that might force rates to rise a little bit faster than expected. Expectations of sooner than expected rate increases have pushed short-term yields higher. Longer-term ones have fallen, in part due to the potentially more hawkish rate policy we'll see to hopefully to tamper down inflation. So you can see that the inflation, how we handle inflation actually has a pretty big impact on the longer-term rates. And this isn't just isolated to the U.S. where I think we're seeing this globally, where short-term rates have started to climb in Australia, Germany, Canada, and other countries where we're starting to see some tightening in monetary policy as well.
Thanks, Chris. Let's take a little different view and let's talk to Dan. So Dan, we have seen some incredible market returns the last 3 years. Can we keep growing at that rate? And then what is going on in the market these days?
Sure, yeah, absolutely. Great question, Betsy. This chart just does a great job of kind of looking over the last 3 years, and really a great 3-year period where on the left, the market has actually averaged 26.1% each year for the last 3 years, virtually almost a double in the last 3 years. I think it's just kind of important to look back. Historically, we've been basically around 10.8% each year. So kind of shows what the market has done with a lot of the liquidity out there from the Fed, and maybe a reason why we're giving back some of these gains that we'll go into some more detail. I think, as we dive into some of the headwinds into this year, kind of going forward, we would unfortunately would love to have 26% returns for the next 3 more years, but we think it's going to be a little bit more normalized. We're seeing some volatility here in January that's going to make it a little bit tougher to climb out of, but we would, hopefully kind of be back in those maybe high single-digit range for returns would be good to see. Kind of interesting, just on the right hand of the chart here, the best 3 year after a great 3 years in the market. What's kind of happened at 3 years after that? Kind of a mixed bag, but it is interesting to see here. Back in 1998, before kind of the tech bubble, we got about a 12% return each year for the next 3 years. But then we also had the tech bubble come down, and we were down about 14.6%. So kind of a mixed bag that we'll kind of explore in some more details. But certainly a great 3-year period. 2018, I think, was the last negative year in the S&P 500. But hopefully we can kind of move past some of these headwinds that we'll talk about and get some positive returns going. So yeah, as Betsy mentioned, we are certainly seeing a lot of volatility here in the market in January. Typically, January is actually one of the better months, and right now it's actually turning out to be one of the more volatile months that we're going through. And some of the things that Chris talked about is really the Federal Reserve raising interest rates. Very low interest rates are great for stocks, as we've seen over the last 3 years. Typically, their valuations can be a little bit higher. There's not much competition out there with bonds and low interest rates, so stocks have been very supportive. Now, what the market's trying to do is price in when that next when the rate increases are going to happen. I think earlier the Fed came out and says they plan on tapering the portfolio and maybe even unwinding it a little bit quicker than expected. So that's certainly caused some volatility there. Here, kind of have numbers through yesterday, and the S&P 500. We did intraday actually reach correction territory, which basically means it was down over 10%. But we did have a very nice rebound in all the U.S. stocks yesterday. So we're down about 7.41% on the S&P 500. Today, I think we're down another percent or so on the S&P 500. The NASDAQ is kind of more of your growth technology names, has done very well over the last several years. We are seeing some more volatility there as well. And I'd say that kind of goes back almost all the way even to November. A lot of your stay-at-home plays, your Zooms, your Teladocs, your DocuSigns, your Pelotons, those companies that have been growing very fast. Netflix would be one of those that has benefited from kind of the stay-at-home plays. And a lot of those companies don't have a lot of profit. They actually could have negative profit and actually lose money. So you're seeing some of that money exit those names. Some speculation is leaving the market, and just bleeding a little bit over into some of the other names as well. I think, kind of diving just a little bit deeper, it's important to know, as I mentioned, those last 3 years, we basically doubled in the market. From time to time, it's normal to get a 10% correction or even more. And we really haven't had a 10% correction since the pandemic back in March. I know the NASDAQ last year had a little bit of a close to a correction on higher interest rates. But typically you get a 10% correction once a year and maybe a 5% pullback 2 or 3 times throughout the year. So something we're keeping a pretty close eye on, but it is important for investors to know this is normal. It's been a couple years without this volatility. And hopefully we'll probably retest some of the numbers we saw yesterday, but hopefully we'll be able to bounce off of those and move higher as we continue to move forward here.
So Dan, with the current outlook for the Fed and what Chris was mentioning of 2 or 3, maybe 4 rate hikes this year, what will happen in the equity markets?
Yeah, this is an interesting chart just because typically the market looks forward 6 to 9 months at least. So what's actually happening now, as we mentioned, they're already trying to price in these higher interest rates that we've seen on the 10-year and the 2-year, inflation data, things like that. So the market's already looking forward 6 to 9 months, and they're already ahead of the game. What this chart looks at is back in history and all the different rate hikes that the Fed's done. And on average, after the Fed increases rates, so we expect obviously a rate hike in March, basically the stock market on average has been up about 7.3% after that first rate hike. So that'll be obviously something to keep a close eye on. And bonds are very similar. We started the year off in bonds as well. Last year was negative. This year, I think we're down close to 1.5 on certain bond indexes. Albeit we're at very, very low interest rates, very low coupon rates. But again, we might see the same thing where maybe bonds can kind of clip the coupon and maybe we can kind of trade sideways here on the yield level. Another area that kind of goes along with the Fed increasing rates, and I mentioned low interest rates are very supportive of stock valuations, of stock prices. And really, you look back on the last couple of years, there's not been many places to go if you want to grow your money. Unfortunately, bank accounts, money markets, CD rates are virtually at close to zero, and bonds are not yielding a lot. So a lot of the money has gone to stocks, and obviously that does increase the valuations of stocks. And this chart just kind of looks at where we are on current valuations when you look at the S&P 500. The good news is we've come off kind of the top and from the top levels, and a lot of that's due to strong earnings from corporations. So every quarter, the S&P 500 and a lot of publicly traded companies report how well they do on profit, earnings, revenue growth, things like that. And we've had very good earnings growth that we'll see here in a minute. But that's allowed the valuations to come down a little bit. And maybe getting a little bit more attractive. I know we're ahead of kind of our 25-year average, but we're still at extremely low interest rates. Even if the Fed does raise 3 or 4 times, rates are still low and can be supportive. So maybe some opportunities here with the recent sell-off we're seeing. And then earnings is really what drives the market. So as I mentioned, every quarter right now, I think Microsoft's out today. We've seen a number of companies report earnings. Last year, earnings growth was great, 50% year-over-year earnings growth back to pre-pandemic levels, which is great, and that's really been supportive of the market to allow it to continue to do well. Obviously, the market's not backward-looking; it's looking forward, and they want to know what's next. So this chart just kind of shows what we're expecting over the next 12 months or 2022, and we've probably peaked in earnings growth, but still looking to grow maybe at that 8 to 9% earnings growth rate, which is still good. The economy is still doing well. Earnings are still planning on doing well. I'd say the biggest thing would be, as companies do report, is to kind of keep an eye on how the supply chains, see how their profits holding up with supply chains, inflation, and also earnings pressure from wage pressures as well. Same on the international side, 60% developed ex-US grew last year. expecting close to that 6 to 7% earnings growth. Same with emerging markets as well. So we'll be keeping a pretty close eye on our earnings here in this quarter and the rest of the year.
Okay, so with the dollar being, do you want to cover this one real quick?
Yep. Yeah, I'll cover value versus growth real quick. Yep. So something we keep a close eye on is value stocks versus growth stocks. Growths are, think of your Apples, your Googles, your Facebooks, even your Netflixes of the world, growing at a much faster pace than the U.S. economy is. Those companies, and this is what this chart is kind of showing, is those companies have done very well. So their valuations are a little bit higher because they grow a little bit quicker. And that's an area that we're seeing some of those valuations come down, some of the stock prices lose a little bit. But what's interesting is we compare that to value when we're investing portfolios. We want to have both segments, but values think of more energy, industrials, financials. If the economy is doing well, those particular sectors can do well. And see, we're seeing a little bit of a balanced value. Had a very good year last year, and it kind of would flip-flop with growth. If you heard more on Omicron, maybe growth would start to take over. So I think it's important here if we can get some of those. Energy was off to a good start this year. Financials started off well, have sold off maybe a little bit here lately. But if we can get kind of both sectors to start participating and growing, it'd be nice to see value have a little bit more momentum here. The other area, kind of looking at our portfolio, we tend to be pretty close to 50-50. We've added to value stocks a couple times over the last year. Now we're pretty close to a 50-50 split between value and growth. Technology is still going to be a place to be. Companies are still investing. Productivity, those companies are still going to grow. We just want to maybe get that more balanced approach here and add some value stocks.
Okay, so the dollar's been a little weaker in the last couple of months, not extremely weak, but a little weaker than it had been. And the U.S. market's really outperformed significantly the last decade over the international. Do you think there's any opportunity in international equities?
Yeah, great question, Betsy. This chart just kind of looks back and quite remarkable if you look at how much the U.S. has outperformed international. It tends to go in cycles. A lot of that can be tied to the U.S. dollar. We've seen a stronger U.S. dollar, maybe weakened a little bit here lately. But really the last 14 years, the U.S. has outperformed international by 275%. So a very, very strong number. There has been certain periods over the last, over the last 30, 40 years that international has taken over. And we are starting to see maybe some opportunities there. On the next slide here, just talks about valuations. Given that international valuations are really almost at an all-time low when you compare them to the U.S. over here on the left-hand side, basically almost trading at a 30% discount. They've been cheap for a while. We continue to talk about international in our investment meetings, and they can stay cheap for a while. But we do see some opportunities here with, especially even the latest sell-off we've had. International actually has held up a little bit better. We're starting to see some of the Europe nations, the UK, Ireland, areas like that open up from some COVID shutdowns. So maybe they're a little bit behind us here in the US, and as they start to open up, we might see some benefits there. So maybe some opportunities kind of going forward. And then on the yield side, this chart also shows what the dividend yield is in the international stocks versus the US. And obviously at an extremely low interest rate environment we're at today, international stocks actually yield about 1.6% higher dividend yield than the US. So that, the dividend yield helps with performance, helps with total return, can help dampen some volatility. So certainly should help performance going forward. I'd say one area we tend to, when we look at our portfolios, we tend to have kind of been neutral, our international weight for some time, have started to increase that a little bit slightly here, even in January of this year, have increased international slightly, just with some opportunities we think there. China, I think last year emerging markets was negative. We do have some concerns in China, a lot of regulatory issues. You've seen a lot of property managers, Evergrande, kind of default on some of their bonds, maybe get a China bailout. So that there is some concerns over there. China just did reduce one of their lending rates over there by, I think, 0.1% to kind of try to spur some activity there. And they've been on lockdown as well. So, hopefully maybe a little bit less volatility in the international market this year. And then real quick, last chart here, we've touched on some of these areas, but just looking at global earnings growth, I mentioned earlier. This year, Europe and emerging markets looking in that single-digit earnings growth, which is good. It's not negative. But also even Japan kind of having 11% earnings growth as the expectations of the markets. And then back to valuations, this just kind of compares the U.S. versus historical. And we're, again, higher historically. But when you look at some of the other international areas, Europe about 15.2, right on target with its average. So maybe some opportunities. Like I said, the downside that we've seen in the U.S. has not been as much in international. It's held up a little bit better. With that, I think I'm going to turn it back over to Betsy just to kind of give a little bit of recap on some possible headwinds we talked about and go from there.
Okay, thanks, Dan and Chris, for your insights. While we can't predict the future, we can make some assumptions about what we know. It still leads us to be slightly overweight equities relative to bonds. As a long-term investor, equities do provide more return on a long-term basis, even though we do have these periods where we have these 10% pullbacks or recessionary periods. But 10% pullbacks are not something you can time. You just monitor them closely. We do think there are some headwinds, though, that we need to be aware of. And I think we covered a few of them in this, but as you know, the Federal Reserve, while they are beginning to take away some of their accommodative stance, the fear is that they're behind the 8 ball and they're going to have to be much more aggressive. So whenever that has happened before, they've really tightened up, and it can lead to a recessionary environment within 6 to 12 months after they become extremely tight. We don't see that really happening right now, but we just need to be aware of it. And that really all ties into inflation. If inflation does not subside from the 7% level that we saw last year and doesn't get back to maybe that 3 to 5% level that would be more normal this year and then continue to become less every year, the Fed will have to become more aggressive. And that is, it would lead to a more typical business cycle, which we really haven't had for a while, where supply and demand is out of balance, prices move higher, and the Fed needs to tighten and ultimately slows the economy and can push it into recession. So we're going to be very cognizant of those two factors. I think those are the two things that are weighing on the equity market even today is, how much is the Fed going to have to tighten? How much is inflation going to be there? And is this going to subside to a certain extent? Other thing that's always out there, I think a couple years ago, who would have thought we'd still be talking about COVID, but we still are, and it's still out there, and it will continue to be. While vaccines and boosters have helped with the severity of the virus as well as the fatalities, it still limits people from doing the things that they thought they did in a normal life. We all are more cognizant of where we are in crowds, what's going to happen, how's it going to spread, and how will that impact global growth if it continues to see different variants, how it slows down the things. I think the U.S. has recovered probably better than most global economies. Europe, they had a complete shutdown across most of Europe over Christmas again. So that's one of the reasons leading to the international market that there could be more growth potentials in Europe and those developed countries because they did have to shut down again, and those kind of things are happening. But, it's one of those things we have to be aware of. What's going to happen is there going to be a more severe variant that the vaccines won't work on. And finally, I think another big question in the market right now is geopolitical risks. They've certainly increased over the last 2 months with Russia threatening to enter Ukraine, China threatening Taiwan. It just raises all the global risks and the whole concept. The Middle East always has issues going on. Leads to the increase in the price of oil, and we all know what oil has done over the last year, up around $85 a barrel when it was at, negative, I think, in April of 2021 or 2020. So on the future market. So, those are the things we have to all be aware of. Usually geopolitical crises don't impact the market long term. It's more of a short term influence. But we do have to be aware that, anything that happens and how our allies work with us and what we do can impact imports, exports, and just overall inflation. So we need to be aware of that. But all in all, we do believe that the U.S. and global growth will remain positive this year, and markets can move higher with continued earnings growth, as Dan was talking about, albeit at a very slower pace than what we've seen over the last 3 years. Interest rates will continue to slowly edge higher, while the Federal Reserve and other central banks across the globe become less accommodative. They take some of that, the punch out of the punch bowl that we got back in 2020. And so, we're doing a repricing right now, but we think it's going to be a good footing to move forward. So I think that's our comments for today, and I haven't seen any questions out there. Does anyone have any? Please, put them in the chat box. If not, thank you for attending today. Thank you, Chris and Dan, for your time. And if you do have anything, you always know where we're at and give us a call. Thank you.